This is a graph of NVIDIA's net income over the past 5 years. And interestingly enough, the net income gains that NVIDIA has seen over the past 2.5 years correlate almost exactly to the gains that we have seen in their stock price. So in this video, I want to dive into the net income that we have seen from NVIDIA over the course of the last 2.5 years, as well as compare it to some things that we have seen from Tesla and Amazon, and see if we can draw any conclusions around where NVIDIA's stock price could be headed in the future. So if you enjoyed the video, drop a like down below, and if you want to see more videos like this one, make sure to subscribe. NVIDIA has been a monster stock in the last 5 years, going up over 2,500%. And these dramatic gains in the stock price have been fueled by not only top line growth, but more importantly, their bottom line growth. We have seen their net income go from $9.752 billion in the start of 2022 to currently sitting at $53.009 billion as of 7/31 of 2024. And overall, that results in a 96.9% compound annual growth rate in their net income, which correlates almost exactly to the return that we have seen in their stock price over the same time period, which is 93.4%. And this corresponds to a net income total growth of around 444%. And if we look at their stock price over this time period, it comes out to anywhere from 400 to 450% returns. You may look at all this and say, well, duh. All of this makes perfect sense. The more money that a business makes, the more the stock price will go up. But this isn't always the case. Let's take a look at Tesla. Tesla over the last 5 years has returned 1,300%. However, the time period that we want to kind of take a look at is 2019 through till its all-time highs. During that time period, the stock returned over 3,000%. And Tesla was in a very interesting scenario here because they were flipping from being an unprofitable company to being a profitable company. At the end of 2019, they were bringing in around $0.143 billion. By the end of 2022, they had increased that on a quarterly basis to $2.326 billion. This means that over that 2.25 year period, Tesla was able to increase their net income by a compound annual growth rate of 244%. This means from September of 2019 through till December of 2021, net income increased by around 1,500%. However, Tesla's stock price increased by almost 2,100%. And this ultimately comes down to the fact that investors are irrational. They will bid up stock prices much higher than what a company is worth. And this is ultimately translated into PE ratios. PE ratios are the price that an investor is willing to pay versus the earnings the company actually generates. In Tesla's case, by the end of 2021, their trailing PE ratio hit a number of 216. And currently, investors are only willing to pay a trailing PE ratio of around 64 or a forward PE ratio of around 73 for Tesla. If you've been in the market long enough, you are familiar with the quote from Benjamin Graham that in the short term, the stock market is a voting machine, while in the long term, it is a weighing machine. And that holds true even for companies like Tesla. If we look back at 2019, again, we remember in that quarter, they were bringing in $0.143 billion. If we fast forward till today, we can see that in the most recent quarter, they brought in a net income of $1.478 billion. This means that over the last 4.75 years, the net income for Tesla has grown at a compound annual growth rate of 63.45%, or a total growth of around 930%. And if you look at Tesla's stock returns over that time period from September 2019 through till June of 2024, it's about 1,000% return. So their returns almost perfectly match the returns that we have seen in their net income. So let's take a couple of those lessons from Tesla and translate them back to NVIDIA. Right now, NVIDIA's returns in their stock price have almost perfectly matched the returns in their net income. So what this likely tells us is that NVIDIA's stock price has not been bid up up by investors speculating on growth in the future. Right now, it's trading at a value that is warranted based off the growth that we have already seen from their net income. And this is where Amazon comes in, because they can help us paint a picture of where NVIDIA's PE ratio could go if we were to see a slowing down of NVIDIA's net income. Right now, Amazon's trailing PE ratio is sitting at a 44.5, while their forward PE ratio is sitting at a 31.5. In the last 5.5 years, Amazon's net income has gone from $10.073 billion at the end of 2018 to $44.419 billion in their most recent quarter. This translates to a compound annual growth rate of their net income over the last 5.5 years of about 31%, which is a total return in net income of around 340%. However, this is not translated perfectly into stock price growth. Their stock price has grown at a compound annual rate of 21%, or a total return of 185%. And you can see that 180% return here on the chart as well, from December of 2018 through till June of 2024. And the main reason for this variation between stock price growth and net income growth has to do with what investors are willing to pay for Amazon. Their PE ratio back in 2018 was sitting at a 74.4. However, today that has dropped by 40% to a 44.61 trailing PE. And this change in the price that investors are willing to pay for Amazon is directly related to a slowing of growth in their net income. At the end of 2021, Amazon was bringing in $33.364 billion. Here today, that number is $44.419 billion. That means that their compound annual growth rate for net income has shrunk to around 12% from 30% over the last 5 years. So if you believe that Amazon is going to get back to 30% growth for their net income over the next few years, then maybe now is a great time to buy into the company. However, if you think 12% growth is here to stay for Amazon's net income, then ultimately maybe now the stock is just fair valued. So what are the key takeaways for NVIDIA? First off is its valuation. Right now, NVIDIA's valuation is a little bit on the higher end, but it's not to the extreme like we saw with Tesla a few years ago. And overall, that is a good thing because it does mean that there is a little bit of room for compression in terms of NVIDIA's valuation. However, if they make up for that with some net income growth, then it could still allow the stock to grow over time. The second point with NVIDIA is a little bit more hard to determine, and it really depends on the investor and their outlook for NVIDIA. And that is, where is their net income going in the future? Right now, we've seen it grow so significantly in such a short period of time that it's hard to predict where it's going to be in the next 5 years. But we do know that it is starting to slow down. The question is, where will it slow down to? Will it slow down to 30% growth? Will it slow down to 50% growth? Will it potentially even go negative and start decreasing? Personally, when I look at those two factors, the potential of compression for their PE ratio as well as decreasing net income, I don't love buying into a stock like that. So I'm avoiding NVIDIA for right now, but I do think that if it falls and kind of corrects the other direction, there could be a potential buying opportunity. So I hope you enjoyed the video and got some value out of looking into a few of these companies and where their net incomes have trended over time. If you enjoyed, drop a like down below, and if you want to see more videos like this one, make sure to subscribe. And as always, guys, have a wonderful rest of your day. And for the joke of the day, what do you call a moose with no name? Check the comments down below for the answer. Thanks for watching.